Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate, including finding and funding deals, market intel, finding a competitive advantage, and using real estate to live the life that you want. I am your host, Jonathan Hayek, and today I have Brian C. Adams, founder and president of Excelsior Capital, where he spearheads the investor relations and capital markets arms of the firm. He has 10 years of experience in real estate, private equity, and has advanced knowledge in best practices for strategic real estate investing. Brian, thank you for joining me. How are you today?
I'm doing great. Thank you so much for having me.
Of course. Really looking forward to this conversation. Glad to have you here. Why don't we start out with you telling us about your background, how you got started in real estate, and what your work looks like today?
Yeah, absolutely. So I am a New Yorker who married a native Nashvilleian. So my wife and I met in college in Connecticut. We did the Northeast thing for a little bit, and then she wanted to move back home to Nashville. So I'm an attorney by trade. I practiced law for a number of years here in Tennessee, and my wife's family has a family office. And so when I married into it, I became an ex officio board member and got exposed to this whole world of private equity and alternative investing and family offices, which I really didn't know much about beforehand, honestly. So I got exposure to that space. And then through a series of experiences with local organizations, started hanging out with entrepreneurs, caught the entrepreneurial bug, wanted to start a company. And I didn't have a great idea, and I didn't really want to get into venture or oil and gas. And so targeted real estate initially because the family needed exposure to those assets, and they didn't like the options in the marketplace in terms of deal flow. So I was able to bring them some opportunities. And then it kind of built on itself. It became friends and family, other folks. And now we have a broad network of all private investors. So we work with individuals and families on a deal by deal basis. I've been through different iterations of the firm. I'm sure we'll get into kind of lessons learned. But this current platform that I started around 5 years ago, we focus on light industrial flex properties and medical office. We have about a $275 million portfolio and 10 people here in Nashville.
Are you still a practicing attorney, or are you real estate full-time?
Oh, yeah, full time for a long time. I've retired my license despite the voice in my head saying that my dad would kill me if I did that. It just became too much. And I went full time probably 10 years ago now.
And so I want to talk about that transition from, high income earner attorney to presumably high income earner real estate investor. So were you looking for something else because you were ready to stop being an attorney, or did you find something else and then decide to stop being an attorney? What did that transition look like?
Yeah, it was a combination. So I remember I had at that time was networking with a lot of older partners, guys who were in their 60s and 70s who had had great careers at a number of white shoe law firms here in Nashville. And they were pretty uniformly miserable people. They didn't have great family lives. They were in poor health. And, when you talk to them about their careers, I remember this one guy said something I'll never forget, but he said, when I look back at the value I created for the enterprise, it was directly correlated to how much time I didn't spend with the people I love. And I thought that business model sucked. And I didn't really want to do that. And so I started looking for alternatives. And real estate is a pretty low barrier to entry business. And I think rewards entrepreneurship and hustle and all these things that I thought I could bring to the table. And so it was kind of an opportunity because of my wife's family. And then just this knowledge that what was a 3 to 5 year journey, I didn't want to be 30 to 50 years of my professional career.
I think that takes a lot of, self-awareness and sort of looking inward, because I've done similar things in my life where I can see myself in 30 years from now or whatever it is, and you're like, at least me, and it sounds like you went through the same thing, where I feel like, okay, I do not want that. whether it's in my before real estate investing, I was a teacher, and so I could look at teachers that were retiring, whether it's dads that didn't have great relationships with their kids or whatever it is. You can see sort of your life 20 or 30 or 40 years down the road, and you can see kind of your trajectory. And so I think it's really, I think it's inspiring and admirable that you were able to see that, and take a different path, because being a high income earner, being an attorney, there were, you made the comment about your dad not being happy with your decision to not be an attorney anymore. And a lot of people from the outside could look at your decision, maybe at the time, and say, look at all that you're giving up. You have a chance at, this much income and prestige and clout and power, and you're giving it all up for what? For the unknown. Do you have any thoughts about that?
Yeah, I mean, I think what you find, it's a compelling question because if it's law or investment banking or public accounting, any of these kind of higher echelon professional or financial services firms, there's a couple of dynamics there. One, you're in the bit of a golden handcuff situation where the business model is that you work so much that you have no opportunity to have side hustles or outside skills. And so you're beholden to your employer, you're beholden to that industry. They don't want you to be able to go do something else. And what you realize after living it and talking to people, no matter where you are on that spectrum of pay in your market or in your profession, in your specialty, in your industry, you're making just enough to live the quality of life that is expected of you. And so if you're making $1 million a year, but you're in Manhattan and you have 2 kids and you've got rent and the nanny and private school and the club, you're just probably living check to check. And you can kind of go up and down the spectrum depending on kind of what location and et cetera. But that's on purpose. It's meant to capture you and to keep you captive within that space. And I just didn't want to play that game.
Yeah, really interesting. And you made a really interesting comment before about the inverse relationship about of how well the firm does and how much time you spend with your family or doing things that you enjoy. So better the firm does, less time you spend on your personal life.
Yeah, and I'm not opposed to hard work. I mean, I am a worker. I identify as such. I do put hours in, but I just feel as if it shouldn't be a one-to-one correlation that entrepreneurship, creativity, those things should be rewarded and given more value than just grinding and putting kind of 10-minute increments into your diary. I think it's a crazy way to live, crazy way to make a living.
Yeah, absolutely. Yeah, for me, I'm still an owner operator. I don't have a large team working with me, and so for me, I'm all about the hard work, but it's got to be for something. I'm not looking for hard work and 60-hour weeks in perpetuity. It's got to be heading somewhere. So, Brian, you talked about sort of marrying into a family office. And this is an idea, a concept that is sort of elusive to a lot of owner operators. It can be intimidating. And so I want to spend a couple minutes just talking about the family office concept. My perception of the family office, of working with a family office. Let's say I'm an owner operator, and for some reason a family office wants to get into a deal that I have. My perception is that they're going to want a significant cut of the deal, and they're going to want a lot of power and control in the deal. So correct me where I'm wrong. Any of my misunderstandings.
So there's all these adages and cliches when I first got into that community that I thought this is annoying. People keep saying the same thing, but they're totally true. And so when you meet one family office, you meet one family office. And families are crazy. They're unpredictable, they're schizophrenic, they're just like everybody else's, but they have a lot of zeros. behind their bank account, and they have maybe a different set of problems, but they still have problems. So, what I would say to you is there are different vintages or different types of families. Some of these family offices, to your point, if they came up in financial services or they made a lot of money in real estate originally, they're very savvy investors and they behave like a private equity fund, right? And so they will approach you and they will ask for co-GP, major decision making rights, GP economics, control rights, oversight. They understand the fee business, they understand real estate. They're going to be fairly sharp elbowed, probably. Whereas if it's a first generation family office from injection molding or whatever, and they're not as familiar and they just want to be passive investors, it may not be that type of conversation, right? And so the best way, in my experience, to have that kind of relationship is to be very empathetic and to be a really good listener because these families are all trying to solve for different things. If you can help them solve their problem, they will engage with you over time. They have to get to know you, obviously. People invest with people, families invest with families. So I think the profile of family that you reference is one that exists in the world, but it's not necessarily every single one. And there are a lot of people out there masquerading as family offices when they're actually private equity operators.
Very interesting. If a syndication group or a high net worth operator wanted to attract the attention of a family office, how would you suggest somebody goes about doing that?
So I've thought a lot about this. The way to start is instead of starting with your deal and your product type and then taking it to the family office market, you have to go to the family office market and understand their problems and bring them a solution set to those issues. And the only way to do that is to spend time with them, be empathetic, and be a really good listener. So if you know that that's the avatar, if that's the ideal customer profile, if that's who you want to serve, you can't just come up with a widget and try to jam it down their throats because it won't work. So you need to spend time where they spend time. I mean, physically and intellectually, right? So I would go to Palm Beach. I would go to the Hamptons. I would go to whatever the equivalent is on the West Coast and the Southeast, etc. But actually go to these places and see what they're experiencing. I would go to the conferences. I would listen to the podcasts. I would read the books because you'll get a very different flavor than working with a high net worth individual or an institutional investor, right? And the thing that you need to remember is even though they have a large corpus of assets, it doesn't mean they don't have problems. In fact, they probably have more problems than the average person in America does. And you can't just go to them with a handout saying, I know you've got a lot of money, you should allocate to me. That's just not going to work, right? People invest with people that are like them, that look like them, that talk like them. The first 10 or 15 minutes is going to be them vetting you in terms of who you know, where you went to school, what club you're a member of, et cetera, et cetera. Those seem like very innocuous, oh, like let's get some common ground questions, but they are screening, vetting questions. And if you do not answer them correctly, it's not going to work for you. Best way is to get a warm introduction, obviously, from a trusted source, right? But again, to get that, you need to be playing tennis, golf, polo, summering with the right people where they feel comfortable doing that. And so it's not to say it's impossible, but it's not this magic key that will solve all your problems. I think a lot of people just say, oh, if I just meet the right family, like it's going to take care of everything. It's not that easy. It's a lot of work, as it should be. The other thing to keep in mind is these people have a very tough job on the investment side. If you think about if you have a corpus of assets, call it a dollar, and your spend rate is 5%. So to be live in a certain area, to live in a certain home, to be a member of a certain club, to summer in a certain place, to send your kids to a certain school, to fly the way that you fly, to travel the way you travel, it costs 5% annually. Tack on 4% for inflation and the exponential growth of the family, because families tend to do that. two kids have two kids, have two kids, etc. You're talking about net 20% annualized returns to maintain that quality of life over a multiple time horizon, a multiple generation time horizon. Really hard to do. Like Wall Street hedge funds with billions of dollars and Harvard MBAs and Stanford JDs cannot do that. So these families have a difficult problem to solve for. And if you can help them do that, you'll have a great conversation. If you just go to them with some product offering, it's not going to go very well for you. And you can spend a lot of time not getting anywhere in that world.
Really helpful inside suggestions there. Thank you, Brian. Let's get into the deals that you're doing. So you all are focused specifically on medical and flex. Let's start with medical because honestly, I haven't talked to a lot of medical office investors. So let's start there. Let's first start with your buy box in terms of the asset type, the market, and the kind of deals that you're looking for in the medical space.
Yeah, I'd say medical is roughly 20 to 25% of the portfolio. So not the majority, but we do have a number of LPs that have allocations towards that asset class. And so we have some familiarity. $10 million price point, multi-tenant, non-campus. So these are not assets that are on or adjacent to a large medical center. These are typically outpatient buildings that may or may not have been purpose built for medical. And it's usually a mix. It could be a podiatrist, a LASIK center, a dialysis clinic. So it's going to be a range of credit. Typically, 5 to 10 tenants is usual there. And we're value add core plus buyers. So these are day one cash flow, stable assets with some upside that we can kind of right size them to market. And, we're based in Nashville, so we have a focus on the Southeast. Texas, Tennessee, Florida, the Carolinas, Atlanta is a place that we've been spending a lot of time recently. That's kind of generally speaking where we are within the medical world. And yeah, you're right. There's not a lot of people out there doing it. I think it's a misunderstood asset class. For fundless sponsors and syndicators, they just see the word office and they get scared. For institutional groups, they want single tenant class A, credit on campus or adjacent campus. So we're a little bit of a kind of a tweener in terms of what we focus on.
Talk to me about the on campus versus off campus. From what I understand, there is, over the last few years, and it's sort of ongoing, kind of a transition in the medical office space. And it's something that I don't know a ton about. So it sounds like you've specifically targeted off campus, which means not adjacent to a hospital, if I'm correct. So talk to me about your location strategy.
Yeah, so what you find is the on campus or adjacent campus offices are usually newer construction, single tenant, and their cap rates are devastatingly low because of that. And the REIT market really has captured most of that value. And so it's very hard to enter it. We're usually anywhere from 10 to 20 minutes outside of a major medical center, or typically these cluster together in suburban areas. And so they're, in a suburban or exurban area, but usually within 15 to 20 minutes. And we're not doing emergency usually. So these are kind of outpatient but non-emergency type users, where access and parking are two of the biggest drivers. So usually if you're going to the hospital for something, these folks can take care of you in a non-emergency, non-invasive manner, and you just kind of tack it all together in one day is usually the kind of profile of user, if that makes sense.
Sure. You were speaking my language earlier when you were talking about looking for cash flow on day one. So it sounds like you're not looking for huge amounts of distress, vacant buildings. You're looking for some cash flow on day one with some upside. So can you describe, what upside means to you? If that's lease structure, if that's finding tenants and filling vacancy, how are you finding upside in your properties?
Yeah, what we usually will see on the, especially on the industrial side and the flex side, is an asset that has been managed by an individual or a small group of folks for a long period of time who are more focused on keeping the building full than pushing rent. And so what we can usually do is we can go in and we can say, oh, this is 85 or 90% occupied day one. So we feel good about the stabilized nature of it. But rents are two, three, four, sometimes $5 a square foot lower than market. And the submarket has a very tight vacancy rate, right? So if we can just bring it to market, which means our assumptions in terms of lease assumptions are not overperforming the market, just bringing them to whatever the rate, credit, and term is within that submarket. If we're able to do that and increase NOI pretty dramatically, then that's a deal that we like quite a bit. I think in today's market, today's interest rate environment, finding assets that you can actually push NOI on is really challenging. And industrial flex is one of the few that you can do that today.
I want to stick with medical for a second.
Okay.
Um, Talk to me about the push and pull of you find this property, and let's say rents are 20% below market. And I mean, I'll just kind of walk you through my thinking. I have far less experience than you. I'm operating at a much different price point than you are. But my mind goes to, okay, I see opportunity. I could raise rents by 20 or 30%. But what if that tenant decides to leave? Maybe it is a five tenant medical office building, and there is a podiatrist that's taking up 7,000 square feet or something. And you're thinking, this podiatrist isn't going anywhere. I can easily raise rents by 20 or 30%. Talk to me about the push and pull of, yes, I want to raise rents. However, and I'll let you answer that. Are you okay with that tenant leaving and having a little bit of vacancy in order to get market rents, or do you have a little bit of fear of vacancy?
There's always that kind of, as you say, the balance with the push and pull there. I think if the market's tight enough, you have to have the conviction to let it go dark and to underwrite for 12 months of vacancy and get the number that you want. Because the rest of the market will reward you, I think, if you do it. Um, that's been our experience. We've been lucky to be able to execute on that. Obviously, it's always scary when you lose one of those users that you had assigned a 75% probability that they were going to renew and they don't. It's always a hard conversation to have with your LPs because it probably means you're going to have to pause or reduce distributions. But over the long term, on a total return basis, you want to keep hitting that high watermark in terms of rental rate. You'll be rewarded for it.
If rents are low, let's keep it that example of 20 to 30% below market rate. What kind of time frame do you want to see on the lease? Is it better that it's less, like a year or less? Are you good with 3 years left on the lease? What's ideal for you to add value?
On the medical side, these users are very sticky. And so you want kind of a 4, 5, 6 year walt probably, just because there can be a lot of downtime and vacancy on those. And the TI packages are more expensive. When it comes to light industrial flex, sometimes short term is really good because you can push aggressively and your TILCs are not going to crush your cash flow. So who cares? You can just keep building. So I'm fine with a lower walt on that product. Medical, you want a little bit more stability, I think.
Yeah. So talk to me about this. Is you hit on something or alluded to something that scares me a little bit about the office and medical office space, and that's the potential for tenant improvements. So, if you are maybe it's just a renewal, or maybe you're finding a new tenant, and maybe it's an 80s or 90s build out. Maybe the location is great, and a tenant says, "Yeah, we'll stay," or "Yeah, we'll sign a lease, but we need some significant improvements here." How are you? Yeah, what are your thoughts on those sorts of thought processes in terms of tenant improvements in the office space?
Yeah, so for traditional office, for suburban office, which we have owned quite a bit of over the years, we don't own a lot now, but that's what kills you in that business is
Mhm.
the TILC packages just crush you. And they're really out of whack with the fundamentals of real estate. And that's why office is such a challenging asset class. So that is something that we had a lot of trouble with. And this, we don't do traditional office anymore, even kind of pre-COVID. Um, for medical, it's a little bit of a different dynamic because in traditional office, suburban, it can very much be a tenant's market where, these are commoditized assets. And if they go to this building versus building B versus building C, who really cares? If the location is generally the same, the vintages are going to be the same. Tenants can dictate all those things in the market. For medical, it's a little bit different because if you're a dentist or something with a pretty complex build out, those are fixtures. It's fairly painful and uneconomic for you to move those build outs. And so landlord has much more leverage there, right? Where you can kind of dictate a little bit more that, hey, we'd like you to stay, but we're going to, reduce your TI package to X. We'll give you some more term, that kind of thing. Because if you think about yourself, like where you go to the dentist, where you go to your eye doctor, whatever medical services you go to, it's probably all within a 10 or 15-minute drive of your home. And the opportunity cost for you to go another 5 minutes is pretty large. And so once those people kind of have that demographic population cohort in hand, they don't want to lose it. And so it's a bit of a different dynamic.
Sure, I remember. I mean, when I was growing up in my hometown, I went to the same dentist building for like the first 28 years of my life.
Exactly.
And
Yeah.
when I thought about going to the dentist, like I go to this building. That's my dentist. And when I was a teenager and I needed braces and I needed an orthodontist, where did I go? The office directly next door to my dentist.
Right. And that's what we see a lot, right? So we like dialysis clinics that are next to podiatrists, right? Because podiatrists usually will see evidence of diabetes early and they'll say, oh, well, you can just go across the street or across the hallway to this clinic. You see a lot of that reciprocity, and that's why multi-tenant is great sometimes because they can create this effect where people can knock out two or three appointments in one drive, which is great for the asset, obviously.
Talk to me about, let's say you've got a lead on a deal in a new market or in a new submarket that you're not familiar with. You don't have other properties in this area, and this deal fits your buy box. You think there's some room to increase rents over time. Talk to me about how you're getting intel on what market rents are and what the supply is in the market and what the demand is in the market so that you're not getting vacancy only to find that there's already a ton of vacancy in the market.
Yeah, so we're not vertically integrated. So we third party lease and manage everything. We have an asset management team, an acquisitions team, et cetera, here in Nashville, but we rely on local boots on the ground for the day to day working on the assets. And interestingly, in our price point, which is that $10 million price point, there really aren't investment sales professionals typically that focus on that. We're usually working with leasing brokers. Leasing brokers usually make 80% of their revenue from leasing commissions and 20% from investment sales. And so a lot of the time, what we'll do is I will hire acquisition guys and asset management guys who are SEC graduates who were in fraternities. And so I expect them to make 50 phone calls a week and talk with these other leasing brokers in these markets about football and basketball, college sports. And that's how we get most of our intel and most of our deal flow. It's nothing crazy. It's, no secret sauce. But the more conversations that you can have with these people, the more intelligence you can gather. I mean, obviously, we get all the reports from CB and JLL and CoStar and blah, blah, blah. But the actual, like, what's happening across the street stuff, leasing brokers know everything, right? And so you've got to be tight with them. And most of our deal flow comes through that channel. And so we feel very comfortable building relationships with them and knowing that, hey, we're a good buyer, we have a good brand, we do what we say. And if you bring us something off market, we're very likely to give you the work or have you keep the work. And so there's a good alignment of incentive there.
Makes a lot of sense. I love the strategy about talking SEC sports with the local leasing
It
brokers.
is what it is, It is what it is. Yeah.
So the medical is a minority of your portfolio. The majority is flex. So let's talk for a couple minutes about flex. Are you in the same markets in those southeast markets? What do you like about flex right now?
Same markets for the most part. What I like about it is that it's a very unsexy asset class. Usually not very good looking buildings, not in great areas. Usually it's the kind of submarket that's near the airport. So it's away from a lot of people, which is great because it means that there's value there. And oftentimes, given today's world, nobody wants to build more flex products, right? It's not highest and best use typically for raw land. And so there's just not enough of it. This class B flex, which means like partially office retail, partially distribution, warehouse, storage. I call it like the mullet of commercial real estate, where it looks good on the front, but it's like usable in the back, productivity wise. It's just kind of a forgotten asset class. And it's oftentimes a really good economic solution or economically efficient choice for a lot of office users that don't want to be in a suburban high rise, right? And a lot of landlords don't want an HVAC provider or a chimney repair firm or a landscaping company. These things that are kind of tweener users that usually underpin the economy and they're good small businesses. They're not credit. I just think it's a mispriced asset class and really misunderstood. It has all the things that we like and none of the things that we don't like about commercial real estate. So things that we don't like, multi level, because elevators are terrible. So it's not multi-story. These are usually single-story assets. Modified gross rents are a pain, and I think they're hard to keep up with and very hard to manage on an asset level. So these are triple net properties usually, and there's no real common area, right? So the things that you really need to worry about, because they're often separately metered and triple net, which means HVAC is not a concern. The only things you really need to worry about: parking lot and roof. And we feel like with our third party condition reports and engineering firms we work with, we get a pretty good handle on what those costs are. Everything else, nobody wants to put money into elevators. Nobody wants to put money into a common area lobby. Nobody wants to put money into a shared chiller unit in the basement or a boiler unit. Those things always get pushed off and they always come back to bite you.
Yeah, I am myself transitioning out of the residential world and into the non-residential world. I own one of these. It's a single tenant flex property, and under contract for another one. And I love it because we talked earlier about tenant improvements and in this asset class there is an office portion which there could you at some point there might need to be some money put into the office portion, but the rest of it, the warehouse portion, there's not much to do to it. You had mentioned parking lot, you'd mentioned roof, but if you've got a 15,000 square foot warehouse, you're not having to redo the floors, you're not having to paint that, you're not having to redo the drop ceiling, and so I just
Yeah, and you make a good point in terms of something else I didn't bring up, but
mhm,
because these are triple net assets, your rent rates are going to be $10, $11 a square foot, 12, whatever it is,
mhm.
really much lower than 35, 40, 50, $60 for office or retail, which just by nature of math means your leasing commissions are going to be lower and your TI expenses are going to be lower, which just directly helps cash flow, which is kind of what we're all about.
Yeah, absolutely. Brian, we are getting to the end of our conversation here. Went by super fast for me. I've really enjoyed this conversation. A couple more questions before we sign off. What are your biggest challenges or hangups in your business right now?
Not micromanaging my business and letting my ego get away of growing it and scaling it effectively. it's something I'm working through
How are you working through it?
with my therapist and business mentors and YPO guys who have scaled their business effectively. And it's hard to let go after working for 12 years. But sometimes when you've grown something, you've got to be really honest with what the highest and best use of your skill set is. And, I'm in a place where I don't think it's ops anymore. I just don't think it is. And so I need to figure out a way to elevate somebody internally or bring somebody else in and kind of fire myself. That's where I am.
I'm a solopreneur for really similar reasons. I have a really hard time giving stuff up to other people. My default thinking is I'm the best at whatever it is that has to be done. I'm the best at it in my business, and deep down inside, I know that's not true, but it's hard to execute. And it's hard to make changes. So, thanks for being transparent about that. What are your best tips for finding deals right now?
Oh, man, finding acquisitions, sourcing debt, and raising equity is the hardest I've ever seen it. And I've been in the business 12 years. I think just having the mindset that it's not impossible, it's just 10 times harder than it was a year ago, or 100 times harder, whatever the number you want to put on it is. And to be realistic with what the opportunity set is today. So, for instance, instead of just really getting frustrated that you can't find deals, maybe take some of the energy and spend it on a different part of your business, right? And just be honest with where we are in the cycle. And so I've told my team, if we did 9 acquisitions last year, I think we'll probably do 4 or 5 this year. That'd be a really good number to hit. It's not anybody's fault. So instead of working on acquisitions, let's drill down on our asset management. Let's drill down on our social media. Let's drill down on our marketing. Whatever you think the weakest part of the business is, let's spend some time there so that we're ready when the wheel turns and we can go out and acquire more. I think it's just being kind of honest with yourself about how you're allocating your time right now.
What's your top tip for raising capital right now?
Oof. This is a whole different episode. I have a whole process and, for a first-time entrepreneur, first-time sponsor, you can go check it out I think it's on the website, but I think people are terrible at it and they go about it the wrong way. Kind of like what I was saying with families. I think you need to start with the LP profile first and really get that nailed down, and then go to market with a solution set that solves the problems of that discrete investor profile. You can't just shotgun it and talk to your Uncle Bob and an institutional group and a big family office. It's just not going to work. They all have different problems, right? And so I would spend a lot more time on researching your LP profiles than I would on making your shiny, beautiful deal as perfect as it can be. Because at the end of the day, if you can't sell it, you can't raise, you don't have a business.
Yeah. Brian, this conversation has flown by. I'm going to have to take you up on that other episode on raising capital.
Yeah.
If a listener wants to reach out to you, find out more about you and Excelsior Capital, where would you like to send people?
Yeah, I appreciate that. I'm active on LinkedIn, Instagram, TikTok. You can go check out the website, excelsiorgp.com. Shoot me a note, connect with me on the socials, and I'm happy to chat and help any way that I can.
Brian, I sincerely appreciate your generosity today, sharing your time and your expertise. Could have talked to you for a couple hours about what you guys are doing. So sincerely appreciate you sharing all that you have with us today. Thank you so much.
Thank you. I appreciate the opportunity.
Listeners, thank you so much for listening. We appreciate you. If you connected with us, feel free to reach out to either one of us. We'd love to talk with you. Until next time, take care.